Sure, but we are seeing some signs that we might be near a bottom for some stocks.
The problem seems to be what's priced in, what's not priced in. What was priced in last week felt like, or in the last couple of weeks, felt like it was tightening was starting to get priced in, right? The market had come down a lot, come into grips with the fact that Fed's going to be really aggressive moving forward. Now it feels like we need to assess the issue of whether big slowdown and recession are accurately priced in, and it feels like the market's confused about what to figure out right now.
Exactly. Yeah, so, I mean, the approach that I take is, to your point, what is actually priced into the stock today? Is a recessionary scenario priced in, or does the valuation suggest that people expect earnings to fall significantly already? Or is the valuation such that people expect, good times ahead? And so, we're very cautious on names that aren't already pricing in some type of slowdown.
Scott Minerd of Guggenheim, the chief investment officer, was on with me yesterday, and his view has grown more bearish. He once suggested, and not that long ago, that you had a pretty good ramp for the market until the Fed and things really got serious heading towards a recession. He changed his view because in his mind, the Fed is more aggressive and the economy is slowing. I want you to listen to what he told me about what that means for stocks in the environment. Let's listen to Minerd. We can chat on the other side.
Given the aggressive posture of the Federal Reserve, we're going to be meaningfully lower this year in stocks before we find a bottom, because the Fed has made it clear that they do not have a put on the stock market. They've made it clear to us that we're going to be at 1.75% by July. I mean, I think a 50 basis point hike has been advertised for the next two meetings, and they believe that the neutral rate is somewhere higher. So I think at that point the Fed will be an overkill. The weakness in the economy will dominate, and we could be setting ourselves up for a season of pain here, especially going into September and October.
Setting ourselves up for a season of pain. You agree?
I think that there could be more downside ahead for the economy. I'm concerned about it, but I don't think it's universal. I don't think that every company and every sector is going to be hit. But, certainly it's indisputable that, rising rates are slowing rate-sensitive sectors. We're seeing major drivers of the economy, such as like e-commerce growth, software growth, starting to slow. Demand for some consumer discretionary starting to slow. And the issue is that when you have those slowing effects and you potentially have and you do have market declines, those can lead to a self-reinforcing cycle that makes the overall environment a little weaker.
Look, you haven't been afraid to stick your toe in and recommend some retail stocks, right?
Right.
With me on this set.
Yes.
Now I'm wondering, and it feels like for many, Target and Walmart were a game changer for a variety of reasons, but that seems to be what has most unsettled many because of high inflation, the lack of pricing power, margins coming down, earnings getting reset. How do you see it?
Yes. So I think it's interesting because I had been watching both those companies very closely and been concerned about starting to see some more promotional intensity come in and what that might mean for the entire economy. And I think, look, those stocks have been hit and even a follow through today because they're not trading at cheap valuations. I mean, their Target's not expensive here. Walmart's, for the quality of company it is, it's not expensive, but they're not cheap. And so I think people were really caught by surprise that they could have this economic sensitivity. So I think where we're dipping our toe in are retail stocks that are trading at like 5 times earnings. They're trading below pre-COVID levels where a recession scenario is already priced in. And what we've seen is in the past couple of days even, we've seen some of these companies report and even guide down for 2Q or guide down, for the year. And the stocks are ripping because because the values are so low. Now, we do have a lot of stocks that are ripping independent of any news just because people are chasing the junk. But I think in these cases, like the fact these stocks are up on earnings that maybe even they were down in the pre-market, but they rallied because how bad are earnings really going to be?
That was one of the most interesting things from the notes that you gave to our producers, is focused more on the TJXs or Kohls or container stores of the world. maybe more so than the Target and Walmart's from a price action standpoint,
yes.
let's say.
Yes, exactly. Right. And the major price action was sell all consumer, even with Walmart, sell all staples. And a lot of staples are pretty expensive. But what was really interesting to me is seeing, well, where were things selling off? And in full disclosure, like we have a position in Container Store, a position in Kohl's. We don't own TJ Maxx, but I have enormous admiration for the company. And yet they buck the trend, and they buck the trend, because they're not, in the case of TJ Maxx, certainly operating very well, but they didn't guide up for the year. That would have been kind of potentially a weaker print. But people feel like, look, they're operating really well. They're in the apparel category, which apparel sales, by the way, are doing well across the board. We are hearing that dressy apparel, formal apparel, branded apparel, very little price resistance, doing really strong. And the retailers that are doing well assorted well for those categories. Dillard's was very strong, right? The position in Dillard's. And so even in this terrible macro backdrop, what you're seeing is that the more commodity categories in apparel are struggling, but people are willing to splurge. And Target even said on their conference call today, splurge for a little pillow, for an extra pillow for the house, for a dress for your child, something nice. And I think that in these times, even if they're weaker, you're going to see people really be more careful about where they spend, and companies that sell those things that are trading at really cheap valuations might be where there's an opportunity and less downside.
Well, that's why I wonder if maybe we're misreading or overreading Walmart and Target. They just didn't have the right stuff.
Yes.
And they paid a heavy price for not having the right stuff.
Yes.
If it was all of a sudden, and they said exactly the opposite, that the consumer was all of a sudden going into the tank, all of these other companies and stocks would be suffering the same magnitude that these guys were.
Right. And look, the lower income consumer is struggling. And even TJ Maxx commented on their conference call. They said their stores in neighborhoods that are relatively lower income are not doing as well as the higher income stores. So that is, I think, maybe potentially across the board. But for the middle and higher income individuals, like households, we are seeing that they still have money to spend on, especially these less expensive discretionary items.
Let's take a look at one of these retail stocks, which, if you'll bear with me for just a second, Avery, is moving right now. It's Ross Stores. Let's take a look at the stock action. You can see it down 16% on earnings. We need more color on it, obviously, to get inside of the report to find out exactly what the problem is here, whether it is a guidance issue, whether they're suffering some of the same problems that you heard out of Target and Walmart. But nonetheless, the stock is down nearly 17%. Is this one of the names? Just one of you? Oh, actually, you know what? I'm sorry. Bear with me 1 second. I apologize. Let's go to Courtney Reagan, who has more on that. Court?
Hi there, Scott. Yeah, that's right. So you're talking about Ross Stores here, and you see shares are down 15%. The report just came out. The company did put up lower than expected profit, also lower than expected revenue. Comparable store sales down 7%. And the comments here from the CEO are interesting. Give us some color into the quarter, basically saying the quarter started out strong, but then all of these other external headwinds that we've been hearing about started to hit the company. So the government stimulus that was lapping took a hit when you're talking about the comparative sales number. There was a significant customer pent-up demand as COVID restrictions eased. That led up. So that made the comparisons tougher. The external environment proved extremely challenging as the Russia-Ukraine conflict exacerbated inflationary pressures not seen on the consumer in the first 40 years. Now the company is taking this all in and saying, look, the balance of the year is now just much more harder for us to predict. We're going to be conservative in our outlook, and they're taking that down. You can see here investors were surprised even after the commentary that we've heard from other investors, and shares of Ross Store are down 15%. And Scott, we know that the off-price sector has been strong, and TJX perhaps had one of the strongest earnings reports so far that we've heard this week, and so far out of the retailers. So this one's a bit of a surprise.
Yeah, and we'll continue to follow it. I know you will as well. Courtney Reagan, thank you so much as we see that stock slide there. Do you have a view on this one? You follow it?
I do follow it, so we're not involved. So Ross is a very high-quality operator. It's not an inexpensive stock, so any downside surprise certainly can be reflected in valuation. The other aspects of it are that they tend to have somewhat of a lower demographic, and they tend to have less of these dressy, formal, branded apparel categories where you are seeing people spend more and you're seeing less price resistance. And if they have, I don't know know what they're doing this quarter, but they have been much less likely to be raising price. TJ Maxx definitely commented they are benefiting from that. So they feel like they want to continue to give value to their consumer, and so they might be being hit by that as well.
Let's bring in Stephanie Link from Hightower and Odyssey's Jason Snipe. Both are CNBC contributors. We expand the conversation, which is perfectly segued to you, Steph. You own TJX, and you added to it.
Yeah, I did, and I added to it, and I will continue to add to it, especially if it's weak on the Ross Stores news. Clearly, Ross Stores is having a harder time with freight and with wage costs. TJ highlighted those areas as weaknesses for them, too, but they have an entirely new pricing initiative strategy that is helping them not only deliver on margins, but actually increasing their margins. It was an extremely impressive quarter with comps, Marmac comps up 3%, and home goods was down, and HomeSense, their home businesses, fell 7%, but that's basically because they had a 40 comp last year. So net, you're at 33% in terms of the two-year stack. So very, very impressive. The execution is tremendous. As I mentioned, they actually raised their margin guidance, and so this is a kind of story that absolutely you want to own. You want to own pricing power stories. I'll give you a couple of others, not in the retail landscape, but you want to own something like a Schlumberger, because they got pricing power. Their margins are going to expand 200 basis points this year. You have you also have Emerson Electric. You have Dow Chemical. Dow is actually increasing prices by 20%. So there's a lot of stories that you can find in this place, I think, in the market. And I think we just got to look at the Walmarts and the Targets and now the Ross Stores as almost like one-offs.
Because it's very difficult, Jason, to make a blanket statement like you can't own the consumer now because of what you got from Walmart and Target. You just have to own the right ones, and you have to own the ones that are executing better than the others. Now, unfortunately, a lot of times you don't know that until the tide goes out and you find out who executed better and who didn't. But just to say a blanket, don't own discretionary, don't own the consumer, may be too severe.
100%, Scott. I mean, obviously the narrative, there's conflicting narratives just on the state of the consumer. And I understand, obviously, Walmart and Target are major bellwether stocks. You know, Steph has talked about in the past on double ordering and inventory. I mean, that was a problem here with Target, and obviously they had some operating margins losses here, and that's also experienced little bit of a different experience with Walmart with wage pressures. That I think you're right, Scott. I think you really have to be discriminating in terms of what names you're looking at here, because as Steph mentioned, pricing power and margin expansion is the story to really make sure that you're looking very closely at in an environment where inflation is still a major theme and will be with us for some time. So I think it's very important to make sure that we're looking at margins very closely. The consumer is still relatively healthy, not as strong as they once were, but they still are relatively healthy and are still spending.
I mean, all you have to do is listen to it. It would be different if Brian Cornell, CEO of Target, came out and said, we're starting to see trends change and the consumer looks a little bit weaker. Didn't say anything like that. In fact, it was absolutely the opposite.
Yeah, he was certainly optimistic, and you know, I think he's seen a movement of the categories that people are buying from, and they had over inventoried, over assorted in some of the categories that had been very strong. They knew there'd be weakness, and there was more than they anticipated.
We got another stock that's on the move in big time because of earnings. It's Palo Alto. Frank Holland has that. Frank.
Hey there, Scott. Shares of Palo Alto now up more than 10% after earnings, where they reported a beat on the top line and a beat on the bottom line. EPS 11 cents above estimates. Also some very strong guidance for Q4. Both the revenue and the EPS estimates above what the street was looking for. CEO Nikesh Arora saying that this performance was a testament to the team's consistent execution and capitalizing on broader cybersecurity trends. Again, company raising guidance for Q4, its final quarter of the year, after a beat on the top line and a beat on EPS. 11 cents above estimates. The call starts in just a few minutes. We'll look for any commentary on possible impact or increased demand due to geopolitical issues like the war in Ukraine. And also, CEO Nikesh Arora will appear on Mad Money later today with Jim Cramer, coming up at 6 p.m. Eastern. Scott, back over to you.
Yep. Look forward to that, Frank Holland. Appreciate that, the update there. Stocks up nicely, 11%. Steph, you talk about being in the right space. As the CEO tonight, with Jim, we'll talk about cyber. I mean, I'm not surprised by this at one bit.
No, not at all. I'm surprised the stock is down 21% before this report year to date, but the whole tech sector has been kind of thrown out, baby with the bathwater. Fortinet, which is the name I own, had a very good quarter, and they did talk about bookings being better than billings just because of the supply constraint issue. So I want to hear about what Palo Alto has to say about bookings versus billings. It's probably both very, very good. 24% on the billing side is your bogey, but really good results. Total addressable market for cybersecurity is going to be $1 trillion by the end of this decade. So these are the kinds of names on weakness you absolutely want to be adding to. You know I've been adding to Fortinet, and I will continue to do so on the bad days.
Jason Snipe, Steph just said something that caught my attention, right? The whole tech sector's been thrown out, right? The good and the bad. Is now the time to really take a hard look at some of the stocks that have been unfairly beaten up, or is it just too dicey? Is it too soon because the market environment itself just feels so unsettled?
Yeah, Scott. I mean, obviously, tech has gotten beaten up tremendously, and obviously there's been the multiples have come in some. You know, Palo Alto, you know, a name that I own, and really happy to see the print here. I mean, they've beaten 19 out of the last 20 quarters on revenue. They've beaten 20 out of the last 20 on EPS. You know, so it's really nice to see them move here. But I think, you know, obviously it's hard to call a bottom in tech in all the sectors. You know, I think there's obviously some. You know, there's probably some volatility still here in technology, but these multiples obviously are far more attractive than they were a month ago and even where they were 2 weeks ago. So I think you could start to leg into some of them, you know, but again, I think it's looking at pricing power, looking at margin expansion are the important themes to make sure that you're making the right choice here.
Well, you got to watch this interview we have coming up. Eric Jackson is coming up, and you talk about hard to call a bottom in tech. Wait till you see the area of tech which he is about to say might have bottomed. I mean, maybe you're going to be surprised, and don't go anywhere because that interview's coming up too. But what do you think, Avery? Technology right here. Too tough?
So
good plays? What do you think?
I think you still want to be very selective. And I mean, just in general, you want to focus on the fundamentals and focus on valuation because there are some tech stocks that, you know, we're actually, I don't think we own any tech stocks right now, but some are, or maybe one, are coming down to valuations that seem really reasonable. Others, there's still vulnerability if something misses. So, but again, we're not as focused on the sector at the moment. But yeah, it's still remaining more cautious on technology overall. I'm sure that there are, you know, that we've found one opportunity, and there are probably others starting to emerge.
Always great having you here, especially here in person on set. Nice to see you. That's Avery Sheffield. Jason Snipe, Stephanie Link, I'll see you soon. Thanks for your time as well. Let's get to our Twitter question of the day.